Hi, it's Joni Michaels, and it's my pleasure to introduce you to Joe Clark, host of Consider This Program. Joe's a certified financial planner and former professor at Purdue University. He's the managing partner for the Financial Enhancement Group. Joe's passion is teaching people about their money so they don't make inefficient financial decisions that lead to frustration and devastation. The Financial Enhancement Group serves more than 900 families in 31 states and manages more than $400 million. The Financial Enhancement Group takes care of people who don't want to worry about their money so they don't make inefficient financial decisions. Joe addresses your questions about money in 5 critical elements of finance: retirement planning, or what we like to call your life after work, tax planning, investment planning, life happens, the good, the bad, and the ugly of life, and legacy planning. The Financial Enhancement Group can be reached at 800-928-4001 or visit yourlifeafterwork.com. The Financial Enhancement Group is an SEC-registered investment advisor. Securities offered through World Equity Group, Inc., member FINRA, SIPC.
Well, good morning and welcome to Consider This. I'm your host, Joe Clark.
And I'm Angie Kinzer.
Happy to have you along. Angie, we have big things in the works. This is year 20 for the radio show. It's hard to believe that I have done anything for 20 years since I just graduated from high school.
Wow.
Well, okay, that's not true. Started in the industry in 2 weeks before the crash in '87, so I've been helping people with money for 32 years, doing radio. I said 20 years. I guess this is actually the 22nd year. We started in 1998.
Yeah. Now, is this the longest thing you've done? Because I had last week 2 people mention to me your old cooking show.
Yeah, we did the cooking show for a couple of years. Had a blast doing it. Just a little more difficult. People say, you did a cooking show? Yeah, I'm not a chef. I can cook well, but I am not a chef by any stretch of the imagination. What I found is I could teach people how to do food and finance, the 2 things that matter. That and preaching on Sundays would be the 3 things other than family that most people care about the most.
Yes.
Money, food, and church, if they care about church and their family, and you pretty much have it wrapped up. But you are making changes, as Angie, by the way, is all things radio. So if you have a question for her, it's 800-928-4001. What are we doing? What are we changing?
Well, speaking of questions, before, what we would have you do is either call in or shoot us an email that said, hey, this is a question we might have, and we'd try to address it this once a week on the radio show. We are going to try to make it much easier to interact with us and to be able to ask questions even live, and for us to be able to respond right there by live streaming our radio show, which means now we're going to record it visually, not just audibly. And so while we're recording for our radio show later that week, what we're doing right then is going to be live. And so people can tune in and watch us recording the radio show.
So you'll still be able to hear it Saturdays on at 6 a.m. on WIBC and
yes.
Across the nation on the other stations that we're on, Shine and Wilo. You'll all be there. But additionally, you'll be able to see that live streaming video if you want Tuesday night.
Yes, at 6 o'clock p.m.
At 5 o'clock, right?
Oh, yeah, from 5 to 6.
5 to 6 p.m. drive time.
Yes.
And you can listen to it on Facebook, so you'll be able to hear it live when it's on and ask questions. And when the segment ends on the radio, we'll be able to continue on with the dialogue for those of you that are streaming live that want to know more. So all sorts of good things come in to Consider This program. Hope we can have you tune in every now and then. Again, that's going to be Tuesday night from 5 to 6 p.m. Stay tuned. Get signed up on our Financial Tidbits Facebook page, our group page, Financial Enhancement Group, Financial Tidbits, and we'll give you more instructions from there. 800-928-4001. Give Angie a call. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Hello and welcome to Consider This. Joe Clark. You are listening to the best of Consider This put together over the last few years of this show. You can find the information from the show on our website at yourlifeafterwork.com, iTunes. Consider This really is a show that's much more than just the weekly headlines. We work together to try to give you insights and directions into things that you may want to consider about your financial lives. And the questions come in many directions. You can always reach us on Twitter, hashtag AskBigJoe. And of course, you can email us your questions. Consider this, that's all one word, consider this at yourlifeafterwork.com. We break the show down into what we call 5 critical financial elements. One, always begin with the end in mind. So we start with retirement income. Where is the money going to come from to maintain your standard of living? Number 2, then, is the tax plan that needs to be done each and every year before the end of the year. 3 is the investment policy statement. What's going to keep you from getting caught in a downturned market without paying attention, without having discipline to how you want to respond? 4th is life happens. It's the good and bad and ugly of life, the things that we just normally see that take place. Last but not least is the legacy plan. Everything that we do is all about your life after work. That's the name of our website, yourlifeafterwork.com. We want to take what's going on in the world, keep you abreast of changes that matter. Sure, it's always fun to talk about markets and headlines, but what we really want to do is give you things to consider. So as I said, shoot us an email, consider this at yourlifeafterwork.com. Enjoy the show and keep in touch.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
Very happy to have you along.
We are.
Sherry, here is what I have learned through all of the years of running the company and being in the world of finance, and it's that our mind will move toward our most dominant thought.
Meaning,
if I'm thinking about being healthy, I tend to be more healthy. If I think about vacation, I tend to be getting less production done at work.
Right.
If I think about cooking, I'm probably overeating or doing something that's not really good for the hiking part of my life.
Right.
Our mind will move toward our most dominant thought. The second part of that, or the corollary, is that we also move toward the place of least resistance.
I do agree with that.
So the concept is that if we knew that we needed to learn about something, that we would go search out that information and learn it. And we try to, and the world is full of data and information with the internet, and sometimes we get a little overly frustrated. But
right.
Let's say you've got a job, and the job has come to an end, or you're retired, and all of a sudden you need somebody to help you with your 401k. You may go try to do some research on that 401k. At the end of the day, what I find most people do is default to what their friends tell them to do, or to some quick blurbs that they can get over the internet. They can't really get a deep understanding of what's going on inside of their money trying to do it that way. So we end up defaulting to who we like and trust as opposed to understanding the process.
Right.
But the second part of that, though, is that there are things that we do naturally like. Right now, in the world of finance, I'm fond of telling people that there's some people who don't understand anything at all about their money but spending it. And that's okay. It's a very complex world.
Right. Oh,
right?
yeah.
They can balance a checkbook.
Right.
They don't necessarily spend more than they make, but that doesn't mean they understand investing.
Right.
And it doesn't mean they understand taxes. There are some people who
Nobody
understand investing.
understands taxes.
There are some people who understand investing, and there are some people who understand taxes. And Sherry, I would take exception to that.
I know you would.
With
I
we
know.
have 2 major CPA firms that we deal with, and that's what
I
our
know.
practice is based on.
Well, you do.
Well, when you said nobody, I mean, that's
on your own. You know, my hobby horses. We don't have access to the information that you do. That's what I'm saying.
That's not true. You do have access to the information. You just have a life.
Oh, yeah.
You weren't reading emails that were coming from the IRS and private letter rulings
true.
3 times a year in classrooms because it's not important.
It's not in my life.
And when you ask yourself about the financial relationships you have, you need to understand there's a reason why people who sell things aren't reading those private letter rulings or keeping up on the taxes either. It doesn't pay them.
Right. True. Good point.
When you're providing wisdom and advice and guidance, then understanding that tax code does matter because you've got to put it into the right shape. So the thing that people like to talk about the least probably is the legacy plan. Nobody wants to talk about their demise.
No,
And
but
90% of the time when I have a conversation, it may be 80, but it's a high number, is when somebody has lost somebody in their life, or they've seen somebody else in their family go through torment because a will wasn't put together, or a trust wasn't properly put together. Things weren't just put together concisely. Now, the other problem with this is people want to have things done. All right. When somebody walks into my office, they want to know that it's complete. And as I try to tell them, the only thing that is really complete is your financial vision, right? Here's who Sherry is. Here's where Sherry wants to go and to get done. Your goals and objectives usually don't change unless something changes in your life. Your financial vision about legacy usually doesn't change. Maybe the charity changes, but it usually doesn't change. What does change are all of the other things that go along with it. Mm-hmm. And what people really want is to be able to check the box off and say that it's done. So, we're in 2017. Last week I saw a will written in 1983. It's probably a little bit outdated. I don't care who you are. Two of their 30-year-old kids weren't even born, right?
Wow.
So you kind of have to get this stuff updated every now and then. And it is very difficult. I'm not an attorney. I don't play one on TV or radio. I work with very, very competent attorneys. And what I try to assure everybody in the room is hopefully none of us die with these documents in place. And it's not because they're not bad. It's just because my objective is not to die in the next 24 months.
Right, exactly.
I don't want to try these things out.
Right.
But just in case God calls me home or my wife home early or something happens to one of my kids, I want to make sure that we have stuff in order.
Makes sense.
Where we are prepared to be able to function.
Right.
So the majority of trust that I see that come in, and a trust is just another way of being able to own stuff. Most trusts that come in have a couple problems to them. All right. So I'm going to give you some of the key players just so you can understand where they are. And if you came into the Financial Enhancement Group, we would work with your attorney and your CPA to actually put this stuff together. We build the estate plan on the whiteboard. And Sherry, in all fairness, I will never give you a trust that came from another client or came from another attorney.
Good.
That's their work product. And that's like stealing, right? It's like pirating software or music. We just don't do it. The good part is, after doing this for as many years as I have, and as many places as I have, I've read a lot of trusts that had some really good ideas. And I'm able to look at your attorney and go, what about this idea? Now, they've got to put it into legalese.
Sure.
And it may or may not be right for you. We work together as a team to get that done. But there's some good conversation that can come from a lot of experience.
The concepts.
But you've got the grantor, the person who puts the money in. The trustee is the person who's going to run the trust. Mm-hmm. The successor trustee replaces the trustee when they're no longer able to serve because they're either dead or incapacitated, mentally or physically. Then you've got essentially the remainder beneficiaries that are there. The two biggest things that I see happen with basic trust are people forget to fund the trust. They forget to put assets in them. And again, we talked about life insurance earlier. I don't want to do that all day, but let's go back to that conversation again earlier. Life insurance is income tax-free, right? That does not mean that it's estate tax-free. There are two very, very, very different conversations that are going on there. And if things aren't funded correctly within various types of trust, you can easily add more assets to your estate that you didn't intend to originally. What I'm trying to tell you is it's complicated and things change. Many of you listening to the show have two trusts right now, one for you, one for your spouse, or one for you and one that becomes the family trust if something happens to you. Because of portability, that may not be necessary for you anymore. Indiana inheritance tax is gone. It's time probably to sit down, have a conversation, make sure this stuff is updated and actually matches with your long-term financial objectives. Do not be like Prince and die without a will. Or even the attorney says, even if I knew his wishes, even if I knew what he wanted, I can't do it because I have to act in the best interest of the estate, which is clearly different than what Prince put out in public news formats and things that he said the last years of his life.
Wow.
Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. Shoot us an email, considerthis@yourlifeafterwork.com. Enjoy the show and keep in touch.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
So happy to have you along. You're listening to Consider This. And you know what? I want to try to give you things on this show are things that you can consider. And Sherry, here's one for you.
Okay.
Cheesecake
I love cheesecake.
is a beautiful thing.
I love cheesecake.
But tomorrow is coming.
Oh.
That means the more cheesecake we have today,
That's
the bigger problem we have tomorrow.
Yes.
Right? Now,
Yeah.
I've been very blessed in my 50 years of life to be able to do a lot of things. And one of my most recent hobbies that I took up was hiking.
Mm-hmm.
So I've been able to go to Africa to do Mount Kilimanjaro. I've hiked the Grand Canyon.
It's amazing.
I love hiking, but it means if I'm going to do this, that I have to keep my body in what we would call trail shape.
Yes.
Right? That does not mean a marathon.
No.
I'm not an itty bitty skinny guy.
No.
It just means I can't have too much cheesecake.
I was going to say
And,
cheesecake's not on the diet.
without getting into the gyms. And the bottom line is some days and some decisions that I make and that you make are obviously better than others. But I have to use my time to make more good decisions than bad. When you look over the course of a week, of a month, of a quarter, of a year, you're going to have bad days, bad weeks, bad months, maybe even a bad quarter, but you can't have a bad year, right?
Right.
Life is just too short. And we understand the impact of eating cheesecake. It feels good today, right? And it's so easy to get caught in feeling in that moment of today. Now, why do I bring this up? Well, it's because it's the investment world.
Okay.
It's where we get into trouble. People see things that feel really, really, really good, and then our minds begin to get rid of all of the things that were really, really bad.
Are you talking about investments now?
All investments.
Okay.
Actually, and again, Sherry, behavioral finance and psychology of relationships are not that different.
Right. Okay.
I mean, it really isn't.
Right.
But back in 2002, on this very radio show, I looked at the world and I said, listen, I know 9/11 was ugly. I know 2002 was a horrible investment year, but you need to buy all of the property that you can buy,
You said
meaning
that's when?
housing, back in 2002.
Okay.
I also knew back in 2006 that the housing world had to come to an end. Now, that was purely demographic, but we're going to talk a little bit about that. One of the reasons people liked housing so much is a thing that's called complementary spending, right? Complementary spending is, Sherry, when you buy a new outfit, I know you.
Yes.
That means you're going to buy boots too, right?
Probably.
You're probably going to buy a purse too. You're probably going to buy,
earrings,
that's complementary
yeah.
spending. You
Yeah.
spend $1 and it entices you to spend others,
Mhm.
right? When you bought your home, it did no good without a couch and drapes and microwaves and all,
Paint.
so tons and tons of what we would call complementary spending that goes on. And in housing, that's as many as 40 different sectors that are out
Sure.
there that are dramatically impacted.
Okay.
The consumers felt better because housing was getting more, was growing abundantly. People worked. There were jobs. Investors got rich. Finance firms were jolly. And the economics looked incredible. But an obvious bubble was being built. People just chose to ignore it. Now, back in 2002, I told people in this show they should buy all the real estate they should buy. And in
Right.
2006, I told investors, not the real estate investors, but I told people from a technical standpoint that it was time to be getting out of financial stocks. Now, understand, when we manage money in here, there is a difference between talking about an economy. The economy was the housing, right?
Right.
Unless we're
right.
talking about your own individual house, the housing market going up didn't make you rich.
Right.
What made you rich was the tertiary things that were going on around with it. The Fannie Mae's and Freddie Mac's going up, the bank stocks going up, the mortgage stocks that were going up.
So when you say what makes you rich, you're talking about your portfolio.
Talking about
now.
your portfolio.
Right. Okay.
Or what you're looking at in your 401k statement.
Okay.
Right? So as you've got all of these things in abundance that are really looking good, it's easy for us to close our eyes to the negative that is going on.
Okay.
And just as when I'm on CNBC or any of the other Fox Business, and they ask me an economic question, what I'm trying to tell you is the economics was the housing condition. It was the demographic demand to buy houses, and we can talk about that in the office or in another conversation. The investing part, when we talk about the market, when we talk about what happened to your 401k in 2008, that breakdown really occurred in 2006. And what I ask people is, what was your process for identifying that? I had a lot of very wise people look at me and go, Joe, it was clear to me housing was too expensive. Well, true, it was.
Right.
But what did you do about it from a market standpoint? What did you do about it from a 401k standpoint? What did you do when you had this data input?
Could
right,
you do
of
anything
housing?
about that?
Well,
I mean,
absolutely, you could do it. So,
Okay.
at the Financial Enhancement Group, we use our risk barometer
Okay.
to tell us the condition of the market, whether it's overvalued, whether it's undervalued, whether it's just neutral.
Okay.
That tells us how much of your money belongs in a given area, whether that be equity or fixed income or wherever else.
So, question: certain areas overvalued. That means you should sell or buy, or
If it's overvalued, you begin to exit camp, right?
exit camp.
I mean,
yeah,
you
okay.
begin
You're
to get
not
out
buying
of it.
in at that
We
point.
owned 0 financial stocks after November of 2006, all the way through the crisis. We probably didn't have any added until
'Cause you saw it
until
coming.
2010 or 11. It's not necessarily that we saw it coming. The risk barometer says how much of your money should be exposed.
Right.
Right. Then we're able to use the narrative, the fundamental part, and the technical part to say, okay, here's what we buy, here's when we buy it, and here's when we discard it, and
Right.
here's
Oh,
when we
yeah.
break down.
Okay.
I can't use demographics and housing to tell you that this is that things are in good shape here or in bad shape here. I can tell you that the narrative says there is a supply of new buyers that are coming, and that this product should be doing well, right? The fundamental side, my CFA, Adam Harder, is able to look at it and go, okay, the business under corporate governance rules is running their business correctly. They're actually having good return on an investment. Their PEG ratios look good. This looks like a good place to be. The technical side is the one who's able to identify something has broken in the stock, not necessarily the economy, right? We told people November of 2006 to get out of financials.
Right.
The housing crash really happened in 07, in the first part of 08. Right.
Right.
So
Yeah.
it's, there's a difference between the narrative nailing it to the day,
Sure.
right, and the technicals being able to say, hey, there is something that just happened, a material change that took place. And I will tell you, in the week of Dow 20,000 that we had last week, in a changing political environment, in a changing economy, if you do not have all three of those processes working for you, you have a challenge.
Sure.
Right. There are people who are purely technical that I think will miss part of this. There are people who are purely fundamental who've already missed part of this. And there's people on the narrative that either were supporters of the new president or not supporters that either did well or did not do well at all.
Sure.
Right. You have to have a process that puts all three of those things into place in terms of where you can.
Makes sense.
So one of the challenges with retirement is that we like to see stock portfolios grow. And we like to see things that make the economy higher. We like to talk about the GDP, the things of that nature. Auto sales are probably one of the other things besides cars, and they've been the darling essentially since the market started to get fixed back in March of 09. The automotive companies may be doing better and better and better. That's good news. What you need to pay attention to is the funding or the liability on the other side, and some of the defaults of the loans are starting to go up. Eventually, that will creep into your portfolio sooner than it creeps into the economy.
Really?
If you're not paying attention to both sides of this, it is very easy to be distracted and lost in the mix. And right now is not the time to get lost. You cannot emotionally wake up and say it's at Dow 20,000, it's too high, or it's at Dow 20,000, it's going to 40. You cannot do that. You must have a process in place and a system that helps you identify the strengths and the weaknesses in your portfolio, that helps you know when it's time to buy, when it's time to sell, and when it's time to technically exit camp. Hey, you're listening to Consider This. I'm Joe Clark, along with Sherry Contos. We'll take a break and be right back.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider This program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, YourLifeAfterWork.com. Now let's get back to the show.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. Shoot us an email, considerthis@yourlifeafterwork.com. Enjoy the show and keep in touch.
Well, good morning and welcome back to Consider This. I'm Joe Clark.
I'm Sherry Contos.
It always entertains me when people make statements that are so affirmative. Joe, we know the market is too high. Joe, we know the market is too expensive. Joe, we know the market has ran too long. And it's usually not families that I take care of. It's usually people who are interviewing me or have got their own bias, and what they're wanting is me to agree with their assessment.
They're almost like everybody knows that.
Yes.
Okay.
And we're having some crazy things happen in the market right now because people are trying to chase returns because you've got underperforming money managers that are out there because they let that attitude seep into their head as well.
Right.
A little bit of a political bias, but there's other issues that go around with it as well. So they said, when would be the worst time to retire? And they're looking at their accounts, and they've got $1 million in their account.
The worst time to retire financially or age-wise?
Financially.
Financially,
right,
okay.
Financially. So they've got $1 million in an account, and they start making assumptions over how much money they can take. And I'll just take you back to the Bad News Bears, and if you spell assume and do some underlining, you can figure it out.
Right.
So that you have to put in some assumptions. I will tell you that the best time to retire is actually in the middle of a bear market. Actually, at the end of a bear market, if you would know when it was, because instead of looking at your $1 million account, remember, in order to be a bear, you have to fall in 20% from the top, right? So suddenly your million's now $800,000, and now you're making a decision as to whether or not you can live on $800,000 as opposed to $1 million,
right? I see.
And then in theory, you will have greater returns. It's called sequencing risk. You'll have greater returns going forward because you've already had the bad years while you were working, right? The worst time to retire, obviously, would be March 10th of 2000, October 7th of 2007. You've got two of the all-time market peaks,
right?
And people, I had engineers from General Motors retiring in their early 50s because the accounts were going up 30 and 40% a year in 98, 99, right? And it's kind of we're printing cash. I'll be a zillionaire by the time I'm 70.
Sure.
And life will be good. Obviously, that is not the plan. So. Here's what I will tell you when you think about the timing of retirement and how we look at it at the Financial Enhancement Group. When I sit down with people, I help them design a budget, and I don't tell you what to spend your money on. Never will, won't do it, ain't going to happen. What I want to know is how much money does it take to maintain your standard of living, because that's what retirement really is about, your standard of living as it is today. And so Sherry's going to tell me that it's $5,000 a month. I'm going to go, okay, $5,000.
Okay.
I'm going to say, Sherry, how much of that is designed for you to go to the place in Canada, to take the grandkids to Disney, what I call social expenditures?
Yeah.
Right? And the reason I do that is we're trained academically as a CFP and all of this crazy computer software. When you go to other financial planning firms that they use, we are trained to take what that number is, that $5,000 a month. I'm trained to look at Sherry, to go to her life expectancy, add 5 years, because that gets me to the 97th percentile, right? And extrapolate an assumed inflation rate, right? We were taught in CFPville that number was 3.84% back in the mid-90s.
I remember.
So we're supposed to take that $5,000 and run out Sherry's life expectancy of another 25 years or so, and then look at it and go, Sherry, you clearly don't have enough money to retire because you're going to need $18,000 a month then.
Right, yeah.
So what we're going to do is either increase the risk so we have a higher assumed rate of return. That's crazy. You got the gun, the barrel, one bullet. Right? It's that game. Because remember, you only got one shot at retirement, so don't blow this.
Yeah.
Do not let a computer outthink you. Do not let, just because everybody else does it, make it okay, because it's not, right? So what you do is you instead of you taking a higher amount of risk on the thing, you recognize that at some age, Sherry will slow down. Now, demographically, across our country, at age 65, we see what's called discretionary spending begin to slow.
At 65?
At 65. In my practice, it's been 68.
Yeah.
And that tends to be because we have people who weren't at bars at 3 o'clock last night, right? Or and tend to be in better, they've had better access to healthcare, etc. But I see a notable change at 68. People either can't get away from grandkids, they can't get away from a doctor, or the comfy couch is simply comfy. Right? And you don't want to go anymore, right? So the concept, the notion to me that people would continue to assume that social expenditures would rise the same way that fixed expenditures did into your 80s and 90s doesn't make sense.
Right.
So after 30 years of doing this, and the first 10 years of behaving, as they would say, doing what I was trained to do as an academic and as a CFP, I now have 90-year-olds with lots of money and not a lot of life.
Yeah, right.
So today what we would do is I would look at you and say, hey, what's that budget, right? Divide it into social and fixed. We take the fixed expense, and we do have to assume there's going to be an inflation rate.
Yeah.
It is an assumption, but we have to assume there will be that. So you have to extrapolate it out. But the social expense, I flatline.
Yeah,
right?
at a certain point.
So in purchasing power goes down every year, but you have more money to be able to spend today and a greater certainty. The second thing we do then is apply the 3-year rule, right? Markets do go up and down. And in 98 and 99, markets were shooting way up. People wanted to come in and adjust their income. We said, no. You know, if it stays up for 3 years, then we'll adjust the income with an appropriate assumption, appropriate rate of withdrawal. If 2008, I had people who wanted to reduce their money coming out. And I understand that nature, but I said, hey, hold on. We have a process for this. We've always had a process for this. We've talked about it before. You do not think that just because 2008 happened that there's going to be a 2009 and 2010. And as we all know, the market worked its way back up and right now at all-time highs. So if 3 years the market is still down, or if 3 years the market is still up, when I do your review in year one, like when we did the family updates in 2008, we said, hey, if the market's still down in 3 years, then we'll make an adjustment to your income, right? If the market is still up in 3 years, we'll make an adjustment to your income, right?
Okay.
But in the meantime, let's stick to the game plan because we know markets often get out of whack in the short term. And I think if I can look at an adult and say, hey, especially retiree, you know, over the next 3 years, you may have to make an adjustment. I think most of us are okay with that. What people aren't okay with is adjusting every 6 months, right? You know, oh goodness, the market went up, I can spend more. The market went down. Oh no, you know, now cancel the vacation. You know, it makes no sense to me. And so we have to have that systematic way of going in. The third thing is to recognize that we do different things with money at different stages of our financial career. When we're talking about retirement, you're going from preservation, where it's the only time that average return matters, but you have to be there beginning, middle, and end to get average.
Right.
Now we're going to distribution, where you truly are pulling money out.
Right.
And your two goals during distribution are to control volatility, number one, and number two, to the tax rate you pay on the average dollar that you pull out. That is our plan of how we're able to take care of this volatility. I don't care if the market's at a peak today when you retire, Sherry. I don't care if it's at an all-time low. With our process, I feel comfortable in saying, here's the amount of money that you can spend comfortably and not have to worry about what's going on. And we've worked hard to develop that process over the last 25 years. It's called Your Life After Work for a reason. I've focused on distribution. It matters, and we're ready to talk to people about it. We'll take a break and be right back.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. Shoot us an email, considerthis@yourlifeafterwork.com. Enjoy the show and keep in touch. We do manage money for a living. That's what I do, and I'm a certified financial planner, so I'm trained to talk about it. But we take care of people who don't want to worry about their money. For some of you that are out there who do want to worry about it, we're trying to give you a base or an education for you to have a better understanding of how your money works. And if you were in the office, I would walk you through a process that is very similar to getting on an airplane, going on a journey. One of the things that we always start with, Sherry, is people's financial vision, a non-quantifiable, and so it's a qualitative statement, meaning there's no numbers, of where you want to wind up, what your vision for your future financially really is. It becomes kind of like the guiding light to help us know where it is you want to go. And then we explain money by reminding you that most of us will go through three very distinctive parts of that journey, and it's no different than going to Indianapolis and getting on an airplane. When you first get on the airplane, the plane is on the ground, and you're getting yourself situated, getting your iPad or whatever it is out, your book to read. They're giving you coffee, but you're getting situated. Eventually, they're going to take off. They're going to get to 30,000 feet in the air, and they're going to ding the thing and say you can go to the restroom and you can walk around if you need to. They're going to fly level, hopefully without any turbulence, and then eventually they're going to land the plane, hopefully safely. Yeah. Now, to me, to you, to the other passengers, nothing has really changed in this trip, in this journey. We just wound up in a different location, hopefully somewhere sunny and warm, but we just wound up in a different location. For us, there was no difference. Now, if I told one of my few pilots, that drive the big birds for American and other, if I told them that they did nothing different in each of those three stages, one would be incensed. The other two would just say, Joe, you're ignorant. They've got very complex things that they need to do. And my friends, you need to understand with your money that you are going through three very complex periods of time as well. And for most individuals, whether they're 18, 45, or 75, they tend to look at statements the same way. And what I've got to teach you to do is to understand it needs to be in an entirely different way. When you're loading the plane, we call that accumulation. And your top two goals in accumulation, very, very clearly, are saving the right percentage of your income. Right? The younger you are when you start, the lower the percentage can be and you be okay. Saving the right percentage of your income. The second then is building tax diversification. You need money in all size of accounts. So you need money that is in a tax deferred situation, money that is tax free, which would be the Roth IRAs. And then you need money that's after tax. You've already paid taxes on it, so it's money that you can access anytime you want. Eventually, you're still saving, but the amount that you've already accumulated is now so much larger. The baby, the nest egg, if you will, is much larger than what you're saving. And at that point in time, you've reached this thing called preservation. Right. Preservation, it's the only time, and please hear me on this, it's the only time when average return matters. And you were there beginning, middle, and end. Otherwise, the average didn't even matter. So, Sherry, when you come into the office, one of the things that drives me insane is we go through this test that's all about risk tolerance. And with your clients. Yes. And my paraplanners go through that with you so that you're aware of what your risk tolerance is and we're aware of what it is. And now here's why I don't like it. My experience, 28 years, I guess now, of doing this, is if you buy a stock for 50 and it goes to 100, you don't call that risky. You don't call that risky. If you buy it at 100 and it goes to 90, that's risky, right? And so when we look at it from that perspective and understand that, it makes it a little bit harder on me. But here's why it is important. Here's why I let people go through that exercise. In that preservation stage where you're still saving, but you're not using your money and you've got that nest egg built up, you have to have the discipline to be able to go through the thick and thin parts of the the market. You just have to.
Yeah.
And if you don't have that discipline, if you've bitten off more than you can chew, or if you become willy-nilly and just jump around a bunch of different strategies, thoughts, et cetera, you just get yourself into trouble.
So let me ask you a question. Risk tolerance. I mean, sometimes people think of that as just whether a person's adventuresome or not. And it's not that really. It's what can you tolerate?
Well,
you literally can tolerate.
Yeah,
stand to lose the money.
To thine own self be true. Not lose the money, but manage to endure through the volatility.
So it's not just your emotional state. I mean, that's what I'm getting at. When people come in and talk to you about risk tolerance, you're not just trying to assess how emotionally they handle the ups and downs. You also have to look at their financial situation.
Yes, that part is true,
Okay.
but it can often be misleading. Right. So most people will come in and they're, 70 years old and they'll say, well, now that I'm not working anymore, I can't afford to take as much risk. I can't afford to lose it because I don't have as much time to get it back.
Right. Exactly.
So, and the SEC and everybody else would agree with them. When Barb's grandmother passed away at 98, I had 70% of her money in equities.
Okay.
Okay, now just think about this. At 98, if she hadn't spent the money already, good chance she really wasn't going to go, right?
Yeah, right.
And at that point in time, the market was doing well, and CDs were very, very low, not quite as low as they are today, but they were very, very low. Yeah. Which one would my in-laws have rather inherited? Right. And, would you rather have the appreciation that have been in the equity environment? Money is a tool to be used.
Right. So most people, though, wouldn't have done that.
No. But grandma was very, very coherent, knew exactly what was going on. And
she was okay.
And the conversations there, she understood how money worked and why it was there.
Yeah.
Now, in 2008, well, I mean, you can even go to now. I'm 49 years old. Mm-hmm. I understand this stuff pretty well. And I will tell you that my 401k today is in balance. It's not in growth. It's not an aggressive growth. It's in balanced because we're in a different economic environment. So it's not just a function of time.
Yeah.
But what I couldn't do is go from aggressive growth to conservative to balanced. That's where that discipline really has to stay in, and to be very, very bright about what's going on. Now, where this gets tricky, my friends, is eventually you're going to land the plane.
Yeah.
And that's when you have to know where you can pull money out, how you get money out of the account, what percentage can you take and not worry about running out. And it becomes very, very challenging for people at this stage to be able to figure out, what's going on and how their money really works, and what it is they need to be paying attention to. And I'm a checklist nut. If you've ever listened to the show, Checklist Manifesto, it's a great book. You ought to read it. One of my top 5 of all times. And you write down those checklists for each of those 3 phases. So what your number one thing to do is to first figure out where you are on the journey. It's not uncommon to have 45, 50-year-old people show up here.
Right.
And really have not done most of the things that they needed to do in the accumulation mode. And meaning there's no tax diversification. In some cases, they've saved plenty of money, but we've got many people with more than $1 million that are all in tax deferred, right? We've got people with $200,000 that's in Roth IRAs. They've converted everything. What we really want is a mixture of those things, of tax diversification across the way. And in all fairness, if you had to pick one, tax-free is going to be better than any of the others.
Right.
But still, the opportunity to be able to make decisions, whether it be gifting or when you can't gift Roth money, right? The decision to be able to make gifts, to be able to write off losses where they exist. You need to be able to use all 3 of those areas, and we have to go back sometimes and help people begin to rebuild it.
Hi, Joni Michaels here. Joe's been hosting financial radio programs for over 20 years, and during his 7 years at Purdue, Joe developed the 5 critical elements. You see, there are 5 areas we all go through that can impact and even derail our retirement plans. YourLifeAfterWork.com has been focused on you on your retirement for over 20 years. You may have had a 401k as well as IRAs. Those are all defined contribution plans. Consider this program is about your defined contribution plans becoming defined distributions. You see, we all exit. You'll either take money out of those retirement plans when you decide or when the IRS decides, or your heirs will have to deal with the situation, but we all exit. I encourage you to call 800-928-4001 to meet with one of the talented financial advisors at the Financial Enhancement Group. I've listened to this show for years, and what Joe says just makes sense. Don't you think it's time for you to call 800-928-4001, yourlifeafterwork.com. Now let's get back to the show.
Hello and welcome to Consider This. Joe Clark, Sherry Contos, and others. You are listening to the best of Consider This put together over the last few years of this show. Shoot us an email, considerthis@yourlifeafterwork.com. Enjoy the show and keep in touch.
Well, good morning and welcome to Consider This. I'm Joe Clark.
I'm Sherry Contos.
So happy to have you along. The purpose of this show, very, very simply put, is to give you things that you really need to consider in a changing world. What we try to do is to break this show down into multiple areas to give you things that you need to consider. Now, what Sherry and I are going to discuss usually are what we call the 5 critical elements. So the first one is what we call your life after work. That's where we talk about retirement. Secondly is tax planning. It's something that needs to be done before the end of every year. It's before December 31st. It's not what you tell your CPA. It's the story that you're able to provide so your CPA can then report for you. Third is the investment playbook, how you invest, how you look at your money. Fourth is the good and bad and ugly of life. It's stuff that just happens.
Yeah.
And last but not least is the legacy plan. Where do you really want it to all go when you're done? Well, Sherry, what we know is that it's easy to get at when you have a frustrating moment when things change.
Yes.
When you thought you had the rules all figured out.
Yes.
Right? And it doesn't matter if we're talking about relationships. It doesn't matter if we're talking about investments. It doesn't matter if we're talking about pretty much anything in life. We tend to throw everything out at one time. You know,
react.
We react. Yes. Overreact is what we would say.
Okay.
I've never been a broker where I got paid to buy and charge people commission to sell stocks. That's not,
right.
We're registered investment advisors.
Exactly.
But what I know is that when people come to see us at the Financial Enhancement Group, they are so used to anytime they make a decision to leave a wirehouse, to leave a Merrill Lynch, or to leave an Ed Jones to come here, their assumption is that we're selling everything because that's
when they move.
Because that's what's always happened to them before.
Right.
Well, there's a difference when you get paid to manage money, when you get paid to make good decisions like we do at the Financial Enhancement Group, versus getting paid to offer a stocks tip. Right? The only way that people get paid at the new incoming place is if they can sell you something that's new.
And so they sell off all the old and buy all new, and then
so the people that do it with the salespeople under suitability or the brokers tend to throw it all out.
Right.
But people who do it on their own tend to do the same. When I go back and I look at 2008 and I would talk to people that I knew in the industry, you know, they would call their brokers up and they would just liquidate everything. They would throw the baby out with the bathwater without having any real conversation over what's going on. And what I want to help you today to understand is there are some things in life when we have these changes where we really need to take a step back and say, okay, something about the situation has changed. It could have been the tax code. It could have been your personal life, right? Your kids grew up and you no longer need life insurance, or you're no longer married, or you've retired, you know, you don't need disability income anymore. There are things that can change in your life. There's things that can change in the economy. And of course, there are things that will constantly change inside of the tax code that we just obviously need to be aware of. And so one of my big things that I've seen, and I was fortunate enough to teach financial planning for Purdue University in Lafayette, Indiana, as an adjunct assistant professor for 7 years. So for 14 semesters, one of the biggest blessings that I got was that I had to start over every semester. You know, you get caught in this world, Sherry, where I know what I know.
Yeah.
I also don't know what I don't know, but I know what I know. But my presumption is the better I get to know it, the more that you as the co-host or you as the listener know the subject matter. And the reality is some of this stuff is very, very, very complicated.
Right.
So let's look at one of the biggest holes that I see, and that's in the life insurance side. Life insurance may or may not clearly involves how much insurance do you need, right?
Right.
It clearly involves what kind of investing are you doing, fixed, which means they're going to give you a guaranteed rate of return, or variable, which means you're subject to the whims and wills of the market. So you've got the insurance component, how much do I need? You've got the market component that's going on, and then you've got the tax code in the background.
So you said the biggest hole you see. You mean like where people don't understand?
One of the big, and what I'm trying to emphasize is we talked about those 5 critical elements.
Right.
Is here we have 3 critical elements essentially coming together under
In
one
one
decision.
thing. Okay.
Right.
Right.
And so you may understand one part of it or you may not. Our natural assumption or our natural response is to react, right? This
Right.
insurance guy sold me this product. I didn't really need it.
I'm so mad at him.
He
Yep.
told me I was going to have $649,000 in cash and I've got $200,000 and now the insurance company says I need to put in more money. I'm just going to get rid of it.
Right. So what you're saying is people don't understand the additional effects of that choice.
They don't understand the additional opportunities
okay.
or situations, right?
Okay.
I will tell you, ideally, if you have a permanent life insurance policy that you're getting ready to replace, ideally you didn't buy it in the first place. But we can't go back in time. Right?
Okay.
I can't go back and fix the fact
right.
that the market didn't go up as high as people thought.
Sure.
I can't go back in time and fix that guaranteed rates weren't as high as what you had assumed they were going to be.
Right.
What I can do, because of the way our team operates, because of the components of understanding the tax code, and remember there are 2 tax codes, folks, one for the informed, one for the uninformed.
Yeah.
I can take the tax code that we understand, I can take the knowledge of life insurance, and I can take the understanding of investing and try to wrap this into a situation that actually provides you some lemonade.
Right.
It wouldn't be as good as having all of your money back,
Right.
but it beats the heck out of getting hit over the head with a sharp stick.
Sure.
Right? And so there are
It's
things
less damaging than if you just reacted, is what you're saying.
there are things that you need to understand. And
Okay.
as you go forward in your financial relationships, you have to really ask yourself, as you look at your situation and your opportunities, are you in the right fiduciary relationship? Are you getting paid? Are you paying somebody who's providing you suitability issues, which means they have to sell you something? Or are you trying to provide somebody getting paid for giving advice, or what I like to call wisdom? Right. When I look at the solution to a bad life insurance policy, whether it be fixed or variable,
Yes.
it is not a commission-based solution. The person who should be providing the guidance isn't going to get paid for it unless they're getting paid for the guidance, not for selling a product. So if you're working with a registered investment advisor, the certified financial planner that understands the planning process, there is an opportunity here to be able to make that situation better. And what my team would ask you if you were sitting down with us is, hey, first of all, what is your tax basis in the product? And we have to remember with life insurance, right, you never get to take a loss on your tax return. So if you put $100,000 in a life insurance policy and you surrender it, that $100,000 is gone. You're going to get whatever cash is left. Maybe
Right.
it's $50,000.
Right.
But the $50,000 loss is there in perpetuity. It is gone.
Wow.
What if there was a way to save that $50,000
That
loss?
sounds like a
what
good
if there was
idea.
a way to be able to use it? But again, you have to make sure that you have the right relationship, somebody that has a full toolbox that can use it. You know, if you're an artist and you only have a red paint on your palette, your picture is going to be red. It's the only way they know how to solve it.
Sure.
And what you have to understand is that we are all unique. We have unique situations. You have a blank canvas, if you will, and you need to have an artist that has the ability to use all of the colors, to understand the tax code, to understand the investment side, to understand the legacy planning, to make sure that it all matches, and to help create that cohesive plan that comes together that helps turns situations, bad situations, because it happens. People
Sure.
make mistakes.
Right.
Things do change, but you've got to be able to bring them together.
Hi, Joni Michaels here. We know you care about your money, but are you tired of worrying about it? The Financial Enhancement Group takes care of people just like you who don't want to worry about their money. As fiduciaries, the team at the Financial Enhancement Group will care for your nest egg just like they would care for their own if they were in your situation. There are many decisions you'll need to make as you face retirement, and the team at the Financial Enhancement Group is here to help you. Call 800-928-4001 or go to yourlifeafterwork.com to set up a time to meet. The confusion and complexity of retirement is almost as daunting as is the excitement of retirement. Don't let your fear and frustration of taxes and investing derail your retirement. Call the Financial Enhancement Group at 800-928-4001. They'll give you a complimentary second opinion on your strategy for retirement. Begin your adventure in your life after work. Call 800-928-4001 or yourlifeafterwork.com. Now back to Consider This program with Joe Clark.
Well, good morning and welcome back to Consider This program. I am your host, Joe Clark.
I'm Angie Kinzer.
I would be remiss to say a couple things. And one, happy Father's Day weekend. for those of you daddies
Yes.
who are out there.
Yes.
It is a big day. It's always it's fun to reflect as a father on things that you've been able to do. I've got 2 daughters that are both fully grown and one married, and so it's important to be able to have that. And I lost my father. He passed away over 20 years ago, but his birthday happens to be Father's Day this year too.
Oh.
And so it's fathers matter, guys. So take some time to enjoy one another while you have that opportunity. Try to make some special memories. It's always fun going to the golf course on Father's Day
I
and
got
watching
ready to ask
the
if you
fathers
get
and
to do.
sons play. And I do if I want to. We're still doing church online. And so, I try to, since Barb doesn't have all of her other friends with her, it's hard not to, because we're social distancing. So it's an interesting thing. But happy Father's Day. Do not forget, starting July 7th on Tuesday evening, 5 to 6 p.m., we will start streaming this show live. You can still listen to it wherever you're listening to it now, on podcast, on the radio station from 6 to 7 a.m., but you also have another opportunity to be able to do it and interact live with Angie, where you can ask her questions, and she'll give you great financial answers, and I'll be there as a backup just in case she doesn't happen to know to be able to help. But, hey, since we're doing social distancing, I thought I found this trivia that I would have never got, and Angie's responsible for all the trivia. I found this, and this comes from the Census Bureau, so it's got to be right. It's got to be accurate, right? The lady who knocked on our neighbor's door multiple times, and her husband had just passed away, would not answer the door for anybody but me and Barb. And this lady would not leave her alone. So I have no idea what she finally put down on the Census Bureau report, but let's assume that it's right. 35 million Americans live alone, i.e., 28% of the households in the United States have just a single person living in the house or apartment. This was before COVID, so they were already practicing social distancing. We have a few people on our team that are introverts.
Yes, who are
that
happy
say
with
that,
this.
Say that they have actually been in training for this their whole life. So it's kind of an interesting world. It's coming to an end in a lot of places. The number of cases in Indiana have just ticked up a tad. Apparently, it's different in different communities, but it's so far it looks like we're opening up here okay. Other places are having some challenges. Apparently, China's back in a little bit of a shutdown in some of their areas that we reported this week in the Market Carver. By the way, if you don't get that, that's a video newsletter we put out every Thursday that covers what we think is most important in the economy from the week before. It's a freebie. Just go to yourlifeafterwork.com and get signed up for it. We'll send you that, our newspaper column that we write weekly, and give you more information. But do not forget to go to Financial Enhancement Group, Financial Tidbits. That's our Facebook group page. If you're not on Facebook, I get it. I'm not trying to tell you need to be. But that group is helpful to be able to distribute information. Keep up with Angie. Give her a call at 800-928-4001. If you're ready for a Next Steps meeting, we will invite you in for a complimentary meeting. We'll tell you what you need to consider today, things for the future, and if we choose to partner together, what FEG will do for you. Happy Father's Day and have a great week.
You've been listening to Consider This Program with Joe Clark. As a certified financial planner, former professor at Purdue University, and with 31 years of experience helping families just like you eliminate the fear and confusion of retirement, Joe's team has the answers to your questions. Go to yourlifeafterwork.com or call 800-928-4001 and find a time to meet with the Financial Enhancement Group. There's nothing that will separate you from your retirement as fast as the IRS. There are many questions that can be answered at the Financial Enhancement Group. Questions like when to take Social Security, how will my 401k be taxed? These questions are just the tip of the iceberg, and you need to be asking these questions now before it's too late. The Financial Enhancement Group has offices in Anderson, Fishers, and Lafayette, Indiana, but they also take care of families in 30 other states. You care about your retirement, you don't want to worry about your money? Then the Financial Enhancement Group is right for you. As fiduciaries, they are required by law to treat your money as if it were their own, and they were in the same situation. Call 800